This is NBR Today. Unsurprisingly, the Coalition Government's Tax Working Group has recommended introducing a capital gains tax, and it's already garnering criticism about its long-term effectiveness. In its final report released today, it says the tax should apply to a broad range of assets, but only when they're sold and the capital income earned. The group says a CGT would raise $8.3 billion over 5 years, and it suggests that money could be used to reduce personal income taxes. The change it most favours is lifting the income threshold at which people pay the lowest marginal rate of 10.5%. Business groups and the National Party have slammed the group's recommendation, and National's finance spokeswoman Amy Adams says the new proposed taxes will create a compliance minefield, distort markets and weaken the country's international competitiveness. So, is she right? I spoke to Tax Working Group Chairman Sir Michael Cullen.
No, I don't think she is. And this is about getting people's attitudes in the right frame. I mean, suppose you continue to invest on something where you think there's going to be a good capital gain, and which will be within the net. So not art, which won't be within the net. Well, and you think that maybe, in 10 years' time you make a $10 million capital gain on a $10 million investment. Pretty good rate of return. Are you not going to invest in that because the return is going to be $6.7 or $7.2 million, depending whether you're an individual taxpayer or a corporate entity? Are you going to cut your nose off completely to spite your face, which is the Amy Adams argument?
Finance Minister Grant Robertson says the government will now consider the report and make its full response in April. In other reaction, experts say the report adds complexity and uncertainty. New Zealand Initiative Research Fellow Patrick Cavallo says the 33% headline rate, if implemented, would push New Zealand to the top of the international CGT rankings among industrialised economies, just behind Denmark and Finland. He said the proposal is conspicuous by a lack of exemptions and concessions for business investment, so a full rate would arguably qualify New Zealand's CGT regime as one of the harshest in the world. Staples Rodway Tax Director Mike Rudd says the CGT recommendations are extremely comprehensive, touching essentially all assets apart from the main home and smaller personal items such as boats. He said the other shocking thing is that this is a proposal for tax on capital gains at the full marginal rates of the person selling it, and there is no adjustment for inflation over the life of the asset. That's out of step with most other countries that have a capital gains tax regime. In other news, Fletcher Building's reluctance to confirm a return of capital when it completes the $1.2 billion sale of its Formica business was a major factor dragging down its share price after the half-year result. Although Fletcher met profit guidance issued last November, its shares slumped more than 6%, with much of the fall occurring after Chief Executive Ross Taylor held a conference call with analysts and investors. Forsyth Bar analyst Matt Henry says the market had supported Fletcher through a breach of debt covenant with a $750 million share offer in April, and now expected Fletcher to return the compliment when the money flows in from Formica. However, they avoided discussing that and said it was one consideration, but certainly not something they were committed to at this point. In announcing its result for the 6 months to December, Fletcher said it expected to complete the sale of Formica by June 30. While New Zealand's larger banks are grinding their teeth about Reserve Bank proposals asking them to increase capital requirements, New Zealand's fifth largest bank's chief executive, Steve Jurkovic at Kiwibank, says he's upbeat about the future of Reserve Bank discussions. He agrees with Reserve Bank Governor Adrian Orr that the proposals to raise the capital requirements for banks, especially the larger Australian-owned ones, will even the playing field for all New Zealand banks. He says the new capital requirements under discussion are not without their implications for Kiwibank, but are worth it to create a strong local banking system.
Yeah, look, I'm not as pessimistic as some of the commentators there. I think there's a really broad range of, outputs there. Sort of, some people saying 140 basis points of cost, some saying 20, and it's going to come out on the wash. So I think, the answer is going to be somewhere in the middle. We're in a sort of unique position given we're all about New Zealand and only in New Zealand, that, we're not competing for capital with our Australian parent or doing whatever. So, look, I'm upbeat about the discussion and where we're going to go.
Fisher & Paykel Healthcare and NYSE-listed ResMed have settled an intellectual property battle that they've been waging since August 2016. The market reacted optimistically to the news, with Fisher & Paykel's share price rising. In a statement, the two companies say the settlement involves no payment or admission of liability by either side. Both parties will meet their own legal costs and all other terms remain confidential. The companies have begun requesting the withdrawal of infringement proceedings against each other's obstructive sleep apnea products. F&P Chief Executive Lewis Graydon says he tried to keep the litigation separate from the rest of the running of the business.
I mean, we're very well aware that litigation can be a distraction, and that's why we tried to parcel it off into sort of a self-contained corner. In terms of running the business financially, we've throughout the whole process kind of tried to look right through the litigation and do what we think is right for the business, irrespective of those costs. But, I think for the market, it does remove a little bit of perceived risk. And, going forward, it is good not to have those costs there.
To tomorrow, our political columnist Brent Edwards asks if national strategy and drumming up concerns about New Zealand's relationship with China is in the national interest. And we'll bring you more reaction on the tax working group proposals. Until then, enjoy your evening.
To unlock your 2 free articles a week, head to nbr.co.nz.